Jobs weakened, inflation cooled, and consumer spending has slowed. And markets have dramatically reduced expectations for another Fed rate hike. Yet, why are mortgage rates still sitting at that 6.76 we saw last week? Because this week showed us something really important. The biggest problem with mortgage rates right now may not be the Federal Reserve at all. The biggest problem, or the real problem, I should say, is the long-term bond market. The Fed has enormous influence over what short-term interest rates do, but mortgage rates are more connected to longer-term bonds, especially mortgage-backed securities and Treasury yields. And those investors aren't just thinking about what the Fed's going to do at their next meeting. They're thinking about inflation, oil, government spending, government borrowing, Treasury supply, and how much return they need to lend money over a longer period of time. That's why the Fed can become more patient while mortgage rates remain stubbornly high. So what happened this week? This week gave us an incredible example. The 30-year Treasury reached a 20-year high. Then on Wednesday, the Treasury Department announced it was expanding an existing program that buys back older, less liquid long-term Treasury bonds. Long-term Treasuries immediately dropped. But here's the important part. By Thursday, that improvement was already gone. Why? Because Treasuries helped with liquidity. It didn't make the underlying concerns about debt, bond supply, oil, future inflation concerns disappear overnight. The mortgage misconception, though. And here's another thing that almost nobody realizes. A 30-year mortgage doesn't trade exactly like a 30-year Treasury just because they both say 30. People refinance, they sell homes, they move. So mortgages have a different duration characteristics and trade in their own market. Everything is connected, but these rates don't move one for one. So what all this means, here's my takeaway. The economic backdrop for mortgage rates is actually better than it was a few weeks ago. Jobs are cooling, inflation is improving, the Fed has more reason to be patient. But the long-term bond market remains the obstacle. That's why I'm optimistic about the setup without pretending rates are guaranteed to move straight down. As always, I'm Bibel. Every Friday I break down what's actually happening and moving mortgage rates so you can make smarter real estate decisions. Subscribe, and I'll see you next Friday.